The landscape of corporate leadership is shifting under our feet. For decades, the name of Warren Buffett has been synonymous with Berkshire Hathaway, but now, Greg Abel is stepping into the role of Chief Executive Officer. This is not just a change in title, it is a fundamental transition that demands attention from everyone who follows this company. Even more importantly, it offers a blueprint for how we should manage our own financial lives. When we look at how Abel has operated at BNSF Railway, we find 5 distinct behavioral frameworks that can transform personal debt management and risk avoidance. These are not abstract theories. They are proven strategies used to run one of the largest rail networks on the planet. Consider this approach to capital allocation discipline. At BNSF, the focus has always been on investing capital where it generates the highest return over the longest time horizon. There is no chasing trends. There is no panic selling. For your personal finances, this means resisting the urge to move money based on short-term market noise. When you carry debt, the discipline lies in paying it down systematically rather than waiting for a tax break or a market dip. Abel does not gamble on hunches. He invests in infrastructure that pays dividends for decades. You should treat your debt reduction plan with the same infrastructure mindset. Build a system that works automatically regardless of what the news says about inflation or interest rates. The goal is stability, not speed. Another critical element concerns risk tolerance and the unknown variable. Investors are intensely scrutinizing whether Abel will maintain Buffett's capital allocation discipline or pivot toward more aggressive strategies. This anxiety stems from the unknown variable of his personal risk tolerance. In your own life, you must define your risk tolerance before you ever take on a loan or a mortgage. Many people borrow money because they believe the market will go up, ignoring their own capacity to handle a downturn. Abel analyzes the risk profile of every major asset before he commits. He does not rely on luck. You should do the same. Before taking on significant debt, ask yourself if you can withstand a period of zero income or rising rates. If the answer is no, the discipline is to wait. Understanding your own risk tolerance is the difference between building wealth and losing it. Furthermore, we must look at the philosophy of insurance float. Despite the leadership change, shareholders seek confirmation that the insurance float and buy and hold philosophy will remain the core engine of value creation. Float is essentially using other people's money to invest, provided you can pay back the claims later. For you, this translates to understanding the cost of leverage. When you use debt, you are essentially borrowing money at a specific rate. You must ensure that any asset you buy with that debt generates a return higher than the interest cost. Just as Berkshire manages its float with extreme caution, you must manage your leverage with the same care. Do not use debt to fund consumption. Use it to fund assets that generate cash flow. This ensures that the money you borrow works for you, rather than you working to pay for the money. Additionally, there is the matter of governance structure and decision speed. A significant trend in watcher inquiries focuses on how Abel's dual role will alter the company's governance structure and decision-making speed. In a personal context, this means streamlining your own financial decision-making processes. Bureaucracy in your life often comes from indecision or lack of clear rules. If you have multiple credit cards, consolidate them. If you have complex investments, simplify them. Abel is looking to optimize how decisions are made to ensure speed without sacrificing quality. You should apply this by creating clear rules for your spending and investing. Have a written policy for when you buy or sell. Remove the emotional friction from your financial life. A streamlined governance structure allows you to react faster to opportunities and threats. Finally, consider the balance between intuition and data-driven decisions. Future implications indicate that the 2025 annual meeting will serve as a critical litmus test for the human capital of Berkshire, where the community's focus shifts from Warren Buffett's intuition to Greg Abel's ability to synthesize data-driven decisions while maintaining the company's unique culture. This is crucial for you because it highlights the need to combine experience with information. Do not rely solely on gut feelings about the economy, but do not rely solely on spreadsheets either. Use data to validate your intuition. If you have a financial goal, gather the data to support it. If the data contradicts your intuition, investigate why. This synthesis ensures that you are making decisions based on reality rather than hope or fear. It is the modern approach to financial stewardship. These 5 frameworks offer a path forward for anyone navigating the transition from the Buffett era to the Abel era, and by extension, from financial chaos to financial order. The market's anxiety is less about Abel's competence and more about the unknown variable of his personal risk tolerance. By adopting these behaviors, you remove that anxiety from your own life. You stop waiting for permission to be financially secure. You start building the infrastructure of your own wealth. The transition of power at Berkshire Hathaway is a signal that systems matter more than individuals. Your personal financial system is the most important asset you own. Treat it with the same rigor that Greg Abel treats the railroad. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.